JimRickards warns, prepare immediately for fallout from massive escalation in the trade wars. JimRickards says the trade wars are about to get much more intense as nuclear options will be used. Here's the details. By JimRickards via Daily Reckoning. What we have seen so far are just the opening shots of the coming trade war. Think of it as the battles of Lexington and Concord that opened the Revolutionary War. Much larger tariffs and penalties are waiting in the wings. Trump will soon receive a report under Section 301 of the Trade Act of 1974. That report has been almost a year in preparation and will reveal that China has stolen over $1 trillion in U.S. intellectual property. Section 301 of the Trade Act of 1974 is the nuclear option when it comes to trade wars. I don't want to get too deeply in the weeds here, but Section 301 gives the president broad authority to impose sanctions and penalties. The president will have a completely free hand to impose billions of dollars of damages if not more on China. Trump could receive this report within days or weeks. Regardless, it is coming soon. Once the president receives it, the law gives him 90 days to react. But he will likely act within days or weeks upon receiving it. Importantly, Trump does not require congressional approval to act. Again, the law gives the president enormous flexibility. So he doesn't need congressional backing as he did for, say, the tax cuts. Initial reports indicated that these penalties will be about $60 billion. In fact, Trump used that figure in today's press conference on tariffs. But that's just for starters. Trump will wait to see if China is willing to make concessions in other areas. If not, he can easily double or triple that $60 billion figure. The penalties Trump seeks to impose are not limited to specific sectors but may apply across a wide range of goods and services from China that benefited in any way from the theft of intellectual property, IP. IP is a very tricky subject with a lot of gray area. Trade restrictions on steel, for example, are much easier to implement. Steel is tangible. You can weigh it, track it, etc. Intellectual property, on the other hand, is much more vague, much more amorphous. It exists inside human brains, or on the internet or a computer thumb drive. It can be everywhere at once in a sense. So it's much more difficult to identify, quantify, and throw tariffs on than traded products like steel, autos, solar panels or washing machines. Yet intellectual property is more important than ever. We live in a world of technology, a world of the internet, of smart devices, and even cryptocurrencies for that matter. These are all forms of intellectual property. Now, China has been stealing U.S. intellectual property for decades in various ways. Sometimes it happens when a Chinese scientist comes to the United States and takes what he learns back to China. But a lot of the theft has been done through malicious hacking of U.S. technology companies. These could be big defense contractors like Lockheed Martin or Northrop Grumman. But they could also be small firms with one great innovation or idea. These smaller firms may actually be more vulnerable because they don't have the defenses against hacking or cyber warfare that the big guys do. With this stolen intellectual property, China has been able to build up companies like Huawei, a large technology and telecommunications firm. And its defense industry has made enormous strides because of stolen intellectual property. Because intellectual property is so amorphous, the president could look at a wide variety of Chinese industries and say, you know those electronic products you're assembling, like smartphones? They wouldn't be so smart if you hadn't stolen some of our intellectual properties. So we're going to throw a tariff on them. These penalties will have a much broader and deeper impact than the steel and aluminum tariffs, or those on washing machines or solar panels. China has issued a pro forma denunciation of the fines and tariffs, but have not announced any specific retaliatory measures in the immediate aftermath of Trump's actions. China will retaliate for U.S. sanctions not with their own tariffs, but with asymmetric financial warfare including diversifying reserves away from U.S. Treasuries into gold and European bonds, and with restrictions on U.S. direct foreign investment in China. Both sides can continue the trade war in cyberspace with ongoing reciprocal theft of intellectual property and intrusions into critical infrastructure. I want to mention one other trade weapon the president has at his disposal, something called CFIUS. CFIUS stands for the Committee of Foreign Investment in the United States. It does not have to do with trade specifically, but with what's called direct foreign investment. That's when a foreign entity from China or Europe or anywhere else buys a U.S. company. Generally, the U.S. has been very open to direct foreign investment in the same way we've been open to trade. But there's always one big exemption, which is national security. And the 1974 Trade Act, which I mentioned earlier, does provide a national security provision to limit direct foreign investment in the U.S. CFIUS is designed to protect U.S. companies from foreign takeovers where national security could be compromised. Nobody cares if a company from a friendly country like Canada wants to buy a non-strategic asset like an ice cream company in the United States. No one thinks that involves national security. But if the Russians or the Chinese wanted to buy AT&T, that's a completely different story. That would not be allowed because that's a critical part of the infrastructure of the United States. That's a simple example of how CFIUS can be used for national security reasons to protect against foreign acquisitions of U.S. companies. The president has already announced that he's going to be very aggressive in preventing Chinese acquisitions of U.S. companies. So that's another arrow in Trump's trade war quiver. He's using them more aggressively than at any time going back to the 1980s, maybe even the 19th century. What are the practical implications of tariffs, IP penalties, and all these trade war developments? First, Chinese companies that export to the U.S. will be hit with tariffs. But U.S. companies like Boeing that import materials from China will be affected also. Further, U.S. companies that export to China will get hit with retaliation. And U.S. companies looking to expand in China will be denied permission. Likewise, many Chinese companies looking to expand to the U.S. will be denied permission under CFIUS. And U.S. companies that are hoping for a Chinese buyout offer may not be able to sell to a Chinese company. But it goes beyond China. You can take those examples and just substitute South Korea or the Eurozone. Will a South Korean company be able to buy a U.S. company if there's a trade war going on? Maybe not. So the trade war is going to ratchet up and get much more intense. Wall Street has its head in the sand. This trade war is not going away anytime soon. It will last for years, likely intensify and be a major headwind for stock prices. Investors need to prepare immediately for the fallout from this massive escalation in the trade wars. It's all starting to make sense. The most sound currency in the world right now is? Hint, they're evil people who meddle in everything and cause myriad ruckus around the world, but talking finances, they're king of the hill, and it will matter. So it's all starting to make sense now. We keep hearing the terms global reset, monetary reset, and financial reset, but resetting what to what, and how would that look? First, why would there be a reset? Resets happen quite regularly for reasons such as hyperinflation, default on debt, breakdown of the system, and loss of confidence, etc. The last reset was in 1971 when Nixon closed the gold window. Prior to that, it was the Bretton Woods Agreement that came out of World War II. And now, we're close to the point of the next reset. The way that a nation conducts a reset, traditionally, which has always been the case and will be the case again, is that gold is revalued to a price that gets it equal to the outstanding debt or outstanding money supply of the nation. Let's use the example of money supply and look at where things stand right now. In our example, let's take M0, which is a type of money supply. M0 is the most liquid type of money there is. M0 is a measure of the money supply which counts all the cash floating around in the system as well as the liquid assets held in checking and savings accounts. Think of M0 as something that can be converted into cash on a whim. So in our example, we will be resetting the price of gold to M0. One question that comes up is, how much of the currency should be backed by gold? We often hear analysts, such as JimRickards, throw out numbers of 20% gold backing or 40% gold backing. I'm not going down that road, however. You see, Article 1 Section 8 of the U.S. Constitution says that Congress is to coin money and fix the standard of weights and measures. Then, Article 1 Section 10 takes it one step further and requires that only gold and silver be our money. This means the dollar, and units of the dollar, and multiples of the dollar, is supposed to be a specific weight and purity of gold and silver. So I'm going to go with a 100% gold backing because that's the only money we're constitutionally allowed to have. And since I'm not a very good mathematician, Santiago Capital has done all the grunt work for us. So looking at the chart above, we can get back to the original question in the title of this article, who has the soundest currency? First, what does that mean? That means that for the amount of gold backing their M0 monetary supply by 100%, this country needs the lowest US dollar price for gold to fully back their currency. In other words, their currency is more sound than those who need a very high US dollar price for gold to 100% fully back their currencies. Said differently, if a nation has a crap ton of currency, M0, out there, and not a lot of gold, they need a sky-high gold price. Look at Japan, for example. Now, the nation that has the best ratio of gold compared to the money supply outstanding? Yup. Russia. You see, Russia only needs a $2,368 gold price to fully back their money supply. Compare that to the United States, where we need nearly a $15,000 gold price to back our money supply. It is all starting to make sense now, isn't it? This is exactly why China and Russia have been so busy stacking the yellow metal. Speaking of China, if we cast aside the World Gold Council official reserves for China and use a number of tons more in line with what many analysts believe, then China has an even more sound money supply than Russia. Again, the math has been done for us, on the working assumption that China really has 20,000 tons of gold and not the paltry stack the WGC says they have. Looky there, China needs an even lower USD gold price than Russia. Unofficially, of course. What can we conclude about all of this? China and Russia are in way better shape than the United States, and China and Russia are in way better shape, financially, than most countries for that matter. Most countries need between a $10,000 and $20,000 gold price to cover their M0 money supply. Granted, this is a country-by-country reset in our example. A global reset would look much different because we would be talking about total global M0 divided by total global gold reserves. But we're not going there for now. For now, we're looking at financial soundness of individual nations. Wrapping it all up, what can we conclude? This is more evidence of the ongoing shift of power from west to east. With the exception of Japan, the east is in much sounder shape than the west, and as they say, he who owns the gold makes the rules. All things considered, China and Russia are near the point, if not at the point, of being able to make the rules. Furthermore, China and Russia are still very busy stacking the shiny FIs, and as just shown, their finances are much sounder than ours, no complicated math or sophisticated models needed. Again, all you have to do is take the nation's M0 money supply and divide by the ounces of gold, and your answer is the dollar price you need for the M0 to be fully backed by gold. In the case of Russia, the math looks like this. 141,237,200,000 dollars, $59,651,090 ounces equals $2,367.72 per ounce. Side note, here's some more high-res pics inside Russia's gold vault for anybody wanting some eye candy of a fat stack. Bottom line, sooner or later the world is going to eat their losses on U.S. treasuries and ditch the dollar. The dollar is on the life support of U.S. military backing. Think about this, if the economic recovery is long in the tooth, with the U.S. military actively engaging around the world in armed conflict since basically September 11, 2001, the U.S. military is surely overextended and therefore the U.S. military support of the dollar is also long in the tooth. In conclusion, China and Russia are busy stacking gold and silver, because they have the opportunity to stack at bargain basement prices, and we're dumb enough to sell it to them at bargain basement prices, all to keep the dying dollar alive just a little while longer.